Vahan Janjigian, Chief Investment Officer at Greenwich Wealth Management. Jahan, thanks for joining us. I want to get to one of your picks right away because one of them is Nvidia, something we don't typically hear from a value investor. It is down substantially from its 52-week high. However, still more than 2 times the market cap of AMD. Its valuation on a forward PE basis, 3 times that of Intel. What are you liking about it?
Yeah, this is a very small position for me. I've been adding to it very recently. As you said, it's tremendously sold off. I am primarily a value investor, but I have very little exposure to growth and technology names. So I decided to take advantage of this. We saw the stock really drop, and I started putting it into the portfolios of some of my more aggressive clients.
Okay, then why go for one of the priciest semi stocks, Nvidia, versus one that has been beaten down so much more, like an Intel or an AMD?
Well, I have Intel too. Intel is really a value stock, even though it's a technology stock, and it's a rather big position for us. I had no exposure to Nvidia until recently, and I decided to add it because I actually think it's one of the better companies out there in that space. However, it is very expensive, even with this decline. But when things turn around, this is the kind of stock that I expect to go up a lot very quickly.
Yeah, and speaking of Intel, Vahan, I know you like a dividend, and that is why otherwise in tech, you're looking at some of those plays like an IBM. What did you make of Salesforce last week? Kind of got overshadowed by its weaker guidance, but a $10 billion buyback for the first time. Do you think we'll see more capital return from tech names going forward?
Well, we might see some more between now and the end of the year because, of course, that 1% tax goes into effect in January. But I wouldn't buy stocks on the hopes that there might be buybacks. Remember that a buyback is nothing but a substitute for a dividend. So it's just another way to return cash to investors. In my opinion, it's actually a better way because buybacks are voluntary. When you pay a dividend, you force the investor to accept it and pay the tax. A buyback allows them to make the decision. But yes, we'll see some more buybacks before the end of the year because of that tax. But that's not a critical deciding factor for me when making investments.
Now, Vahan, you are typically a value investor. I'm a tech anchor, so we've been talking about that. But what I find is so interesting is that you've actually been trimming your energy holdings to buy some tech. Meta is another name that you like. What makes you think that there's room for tech to run now, especially after what we heard out of Fed Chair Powell and his hawkish speech last Friday?
Yeah, only because it's become so undervalued. Energy is a very big position for me. It's a position that I was really buying a lot several years ago when it was very undervalued and everybody was avoiding energy. As a result, it's become a fairly large position in my portfolio. So I'm not negative on energy. In fact, I think energy stocks will continue to rise. But because it's become so outsized in my portfolios, I'm trimming them. And yes, I'm using some of that cash to buy things like Nvidia, which I had no exposure to in the past.
Right. And Meta, as you mentioned. And you believe right now, though, the biggest risk to the market is an over-aggressive Fed. What we saw on Friday, right? We had thought that maybe the markets had come more in line with what we've heard from Fed speakers. But why has that calculus changed? Is it because, it was a little bit surprising to hear from Powell when the data has been a little bit better over the last few weeks. But he says we need to see months of that.
Yeah, so first of all, I would say that pay attention to what the Fed does rather than what it says. I think the Fed's actions so far have been very appropriate. There's no need for them to talk so aggressively. I think he was trying to talk the markets down and scare investors. But as you said, the data indicates that inflation is already waning. So I think it would be a mistake to raise the Fed funds rate by 75 basis points at the next meeting. I think 50 is enough. And I think 100 basis points by the end of the year is plenty. And of course, the Fed says it's data driven, so let them watch the data. I think what Fed Powell would like to see is more weakness in the jobs market. And as I joke, maybe one day when he reports to work and finds out he was laid off, he'll know that he raised interest rates enough.
Okay, well, that is certainly one take, Vahan. Thank you for kicking us off. Great insights.
Shepard Smith here. Thanks for watching CNBC on YouTube.